Welcome back to Income Decoded, the channel where we break down real strategies for making real money. No fluff, no fake gurus, just pure financial intelligence that you can actually use. Now today we are going to talk about the number one reason most people never start investing. And it is not laziness, it is not lack of money, it is fear. The fear of losing everything, the fear of watching your savings disappear, the fear of making the wrong call and ending up worse than when you started. I hear this constantly in the comments. What if the market crashes? What if I lose it all? What if I pick the wrong thing? What if the timing is wrong? These are real fears, and they deserve a real answer, not a dismissal, not a motivational poster telling you to take risks and bet on yourself. A real data-driven, honest answer about what investing risk actually is, what it is not, and what the history of every major market crash in the world teaches us about who actually loses everything and why. That is what today is. Let us get into it. First, let us define what risk actually means in investing, because most people use the word risk as if it has one meaning. It does not. When most people say I am worried about the risk of investing, they mean they are worried about permanently losing their money, that it will be gone, that they will never get it back. But the risk that most investors actually experience is something completely different. It is called volatility. Volatility is the temporary movement of prices up and down. Markets go up, markets go down. That is not the same as losing your money permanently, and the difference between those two things is everything in investing. Let me make this very clear. When the stock market falls by 30% in a crash, your portfolio shows a lower number on the screen, but you have not actually lost that money unless you sell. The loss on screen is a paper loss. The moment you sell, it becomes a real loss. If you hold and the market recovers, you have lost nothing except the temporary anxiety of watching the numbers fall. This distinction between temporary loss and permanent loss is the single most important concept in understanding investment risk, and almost nobody explains it clearly. Now let me walk you through the three main types of risk in investing, because they are very different from each other and they require very different responses. Type 1, market risk. This is the risk that the entire market goes down, a global recession, a financial crisis, a pandemic, a geopolitical shock. In these events, stock markets around the world fall together, sometimes dramatically. The 2008 global financial crisis wiped out approximately 50% of stock market value worldwide. The 2020 pandemic crash dropped markets 30 to 40% in a matter of weeks. Earlier in 2025, a major tariff shock caused markets to drop sharply. These events are real, they are painful, but here is the critical question: what happened after? After the 2020 pandemic crash, the market recovered its losses in just 4 months, one of the fastest recoveries in 150 years of market history. After the 2008 financial crisis, the market took about 4 to 5 years to fully recover, but it did recover and went on to all-time highs. After the dot-com bust of 2000, recovery took longer, over 12 years, but again it happened. Morningstar analyzed 150 years of market crashes. The conclusion was unambiguous. Though they varied in length and severity, the market always recovered and went on to new highs, every single time, without exception in 150 years of data. Now some crashes take longer than others. The Great Depression crash of 1929 saw markets fall almost 90%. Recovery took 25 years. That is the worst-case scenario in 150 years of data, but even that recovered. Every single one recovered. The investor who diversified broadly and stayed invested through all of those crashes ended up dramatically better off than the investor who sold in fear at the bottom and waited on the sidelines for it to feel safe again. Type 2, single stock risk. This is very different from market risk, and it is where permanent losses actually happen. When a single company fails, it can go to zero. Enron was one of the largest companies in the world. Its stock went to zero when the fraud was exposed. Lehman Brothers, one of the oldest investment banks in the world, went bankrupt in 2008. Its shareholders lost everything. Kodak, Blockbuster, Nokia, companies that were once dominant forces in their industries that collapsed as the world changed around them. This is why putting all your money in a single stock is genuinely dangerous. Individual companies can and do fail completely. The risk of permanent loss in a single stock is real. But here is the beautiful thing about an index fund. An index fund owns hundreds or thousands of companies simultaneously. When one company in the index fails or struggles, others rise to take its place. The companies that thrive grow in the index. The companies that fail shrink and eventually leave. The index constantly refreshes itself with the most successful companies in the economy. For you to lose everything in a broad, diversified index fund, the entire economy of multiple countries would have to permanently collapse to zero. Every single company, every single industry, every single country. This has never happened in recorded history, and if it did, your money would genuinely be the least of your problems. Type 3, inflation risk. This is the risk that almost nobody talks about, and it might be the most important one. Inflation risk is the risk of not investing. It is the guaranteed erosion of purchasing power that happens when your money sits in a low-interest savings account while prices rise around it. We covered this in detail in episode 10, but the short version is this. If your savings earn 1 to 2% per year and inflation runs at 3% per year, you are not standing still. You are moving backwards, slowly, quietly, every single year. $10,000 kept in a savings account for 20 years at 1% interest while inflation runs at 3% does not stay worth $10,000. It shrinks in real purchasing power. You might have $12,000 on the screen after 20 years, but in terms of what it can actually buy you, it is worth significantly less than when you started. Inflation risk is not dramatic. It does not show up as a sudden loss on a screen. It is a slow, silent, guaranteed drain on the real value of your money, and it happens whether you are watching or not. The people who avoid investing because of fear of risk often fail to account for this third type of risk. The risk of doing nothing is not zero, it is a slow, certain loss. Now let me address the question directly. Can you lose everything investing in a diversified index fund? The honest answer is no. Not in any realistic scenario that has ever occurred in the history of markets. For a completely diversified global index fund to go to zero, every company in every industry in every country would have to simultaneously go bankrupt and cease to exist. That is not a market crash. That is the end of human civilization. And in that scenario, cash in a bank account would be equally worthless. Can you lose a significant portion of your investment temporarily? Yes, absolutely. The 2008 crisis showed that clearly. A 50% drop on paper over 18 months is real and it is painful, but for a long-term investor who did not sell, it was temporary. The market recovered. Those who stayed invested recovered and eventually grew significantly beyond where they started. Can you lose everything in a single stock? Yes, this is a genuine risk. Individual companies fail. This is why diversification is not optional for a rational investor. It is the single most important risk management tool available to you. Now let me give you the 3 rules that change everything about how you think about investment risk. Rule 1, only invest money you do not need for at least 5 years, preferably 10 or more. This is the most important rule in investing risk management. If you invest money you might need in 12 months and the market drops 50%, you may be forced to sell at the worst possible moment. If you invest money you will not need for 10 years, a 50% drop is just a line on a chart that you can calmly wait out. Time is the greatest risk management tool that exists. Give your investment time and the temporary volatility of markets becomes irrelevant. Rule 2, diversify. Do not put all your money in one company, one industry, or one country. A broad market index fund does this automatically. Thousands of companies, multiple industries, multiple countries. The failure of any single company or even any single industry cannot wipe you out when you own a piece of everything. Rule 3, do not sell in fear during a crash. This is the hardest rule to follow emotionally. When markets are falling, every instinct tells you to get out. Every headline screams that it is different this time, that this crash is the one that will not recover. But 150 years of data says otherwise. Every crash has recovered. The people who sold in fear at the bottom locked in their losses permanently. The people who stayed invested and kept contributing automatically recovered and went on to significant gains. The biggest risk in investing is not the market. It is your own emotional response to the market. Let me leave you with this. I want you to picture 2 investors. Investor A is so afraid of risk that they keep all their savings in a low-interest bank account their entire working life. They never invest. They never have to watch numbers fall on a screen. They feel safe. But quietly, slowly over decades, inflation erodes the real value of everything they saved. They retire with far less purchasing power than the numbers suggest. Investor B understands risk properly. They invest in broad, diversified index funds. They watch markets crash and recover multiple times over their investing lifetime. They do not sell in fear. They keep contributing automatically through the crashes. They retire with a portfolio that has compounded significantly over decades. The risk of investor A is invisible, silent. It shows up only at the end when it is too late. The risk of investor B is visible, dramatic when it happens, but temporary for those who stay the course. Investment risk is real, volatility is real, market crashes are real, but for the long-term diversified investor they are manageable, expected, and ultimately survivable. What is not survivable financially is decades of slow, guaranteed inflation erosion while you wait for investing to feel safe enough. It never feels safe enough. That feeling is the trap. Quick recap. Risk in investing has three types: market risk, temporary. The entire market goes down and comes back. This has happened consistently throughout history. Single stock risk, permanent, possible. One company can fail. This is why diversification is essential. Inflation risk, guaranteed. The cost of not investing, slow and certain. Can you lose everything in a diversified index fund? No, not in any realistic historical scenario. The market recovers. It always has in 150 years of data. Can you lose everything in a single stock? Yes, this is why you do not put all your money in one company. The three rules: only invest money you do not need for 5 or more years, diversify across hundreds or thousands of companies, do not sell in fear during a crash. The biggest investment risk is not the market, it is your emotional response to the market. Drop a comment below. What has been your biggest fear about investing? I want to know. I read every single comment and I reply to as many as I can. If this video gave you even one shift in perspective, please hit the like button right now. It takes 2 seconds and it genuinely helps this video reach more people who need to hear this. And if you are not subscribed yet, what are you waiting for? Hit that red subscribe button and turn on the bell. Every single week on Income Decoded, I drop new videos breaking down real money strategies and real financial intelligence with real numbers. I will see you in the next video. Stay focused, stay consistent, and remember, the biggest risk in investing is not taking part.